Hello, how are you all doing?
Great.
Grand? That is excellent. I have a question for you guys, and I have a question for you folks who are watching this as well. I want you to answer this, maybe jot it down on a piece of paper, or at least make a mental note in your mind. Why are you taking this class? Not Dave Krug, but why are you taking Accounting 2? Why are you taking Accounting 2? Okay, think about that for a second. All right. Now, I asked my students here before the cameras rolled why they were taking it. What are some of the reasons, Jeremiah?
I'm gonna be an accountant, so I kind of have to take it.
Your actual words were I'm required to, right?
Yes.
Yes. Okay. Anybody else say that?
But I enjoy it too.
Okay.
It's an interesting class.
Okay. The reason I'm going through this little mental exercise here is I think a big part of life is getting to the why of you do something. For example, you said I'm required to or I have to. Sometimes people say I have to take this class. Well, you don't have to. You realize.
I'm choosing to be an accountant,
Okay.
so by choosing that, I have to choose to take this
Okay.
class.
Why do you want to be an accountant?
I enjoy it.
Okay. Why is it important for you to do something that you enjoy?
Because then it makes me happy to get up every day to go to work.
Okay. You see what I'm getting at here?
Yeah.
Because sometimes
You
I'll
can always
get.
ask why, though. Why would that make you happy? You could always ask them.
You could always go further. But I think it's good on this to say, okay, because sometimes students say, I'm required to do this. And I say, you're not required to do it. And they say, well, I'm required to do it to get my business degree. And I say, well, why are you getting a business degree? You don't have to get a business degree. Is it the law that you have to get a business degree? Is it a law that you have to get any degree? No. Well, why do you want to get a degree? And a lot of times it comes down to this is, I don't want to do a really hard manual labor job my whole life, right?
Yes.
Has anybody ever done a really tough manual labor job?
Every day of my life.
Yes. And you know what? As tough as it is when you're in your 20s, wait till you're in your 40s, right? Wait till you're in your 50s, right? But I think it's an important exercise that I utilize a lot in my life to ask, why am I really doing this? Because after I answer the first why and then go, well, why am I doing that? Well, why am I doing that? A lot of the time it gets down to, well, it's because I want to provide for my wife and my kids who I love. I want to be able to, have some financial security. I don't want to have to do a manual labor job when I'm 65 years old. But I have found in my own life that when I get to the why I'm doing something, if I know why I'm doing it, it's a lot easier to do. Have you ever gotten to that? Okay? If you know why you're doing something, a lot of times the motivation to do well in it is a lot more apparent. Okay? So think about that. Deep thoughts on a Monday morning.
Say happy Monday.
Happy Monday, right? Okay. Okay, let's go ahead and go through the homework. What we're going to do today, we are going to wrap up chapter 13. Okay, we just have a few exercises or a few homework exercises from chapter 13. They weren't too tough, were they? And then we're going to actually start chapter 15. Okay, we're going to start chapter 15, which is on investments. Okay, now this is lecture number 208. You with me? We will have the test over chapters 12, 13, and 15 after lecture 210. You with me? This is 208. So we'll have 209, then we'll have 210. Now I'll tell you off camera when that specific date is for you, but I don't want to even mention it on camera or it fouls up the people at home. They get confused, okay? So we have this lecture and 2 more lectures and then the test. Cool? All right, so let's go ahead and start. This is lecture 208. The test will be after lecture 210. Okay, I believe I assigned a couple discussion questions, did I not? We don't often do the discussion questions, but let's take a look at discussion question 13 and discussion question 18, okay? Okay, discussion question 13, what's the difference between a stock dividend and a stock split? I'll go ahead and answer that. Well, first of all, I'll say some commonalities that the two items have. They are both means of increasing the number of shares out there without requiring additional payment from the shareholders. Is that correct? And the main reason to do that is to move that market price down to a manageable trading range, a range that can be afforded by current investors and potential investors, all right? Okay, so that is the thing that they have in common. The difference between them is a stock dividend requires journal entries to be made. I don't require you to learn those journal entries, but a stock dividend does have journal entries that have to be made, whereas a stock split does not. Make sense? Okay. There's some other minor differences I'm not too concerned about. I mainly want you to understand what those mechanisms are used for. Okay?
Just want to make sure I'm understanding it right. Because what I read was like a stock dividend increases the amount of equity that the stockholders then own.
Is
that more complex?
No, it is more complex, and the reason I didn't go down that road was that's mainly apparent if you teach all those journal entries.
Okay.
Okay. And again, the reason I'm not teaching those journal entries is not because I don't think you can't handle it. It's just that we have a finite amount of time. In 25 years of accounting, I've never once made that journal entry for a stock dividend. Okay? And you will go over it again in advanced accounting classes, but we have a finite amount of time in this class. I like to concentrate on the things I think you will utilize in your jobs. And I think stock splits are used a lot more common than stock dividends anyway. Okay? So, but yeah, you're right. Okay. Discussion question number 18. What is a stock option? A stock option is, think of it as a coupon that gives the holder the right to purchase a stock at a specified price during a specified time. We talked about this, okay? And I won't repeat the whole lecture from last time, but the hope is that those who hold the stock option will realize that the stock option gets more valuable as the stock price goes up, so they will make decisions for the company as a key member of the company or key executive of the company to help the stock price rise. Okay? If the stock price goes down, that stock option is not going to be worth anything. Okay? All right. Okay, that's it for the discussion questions. Any questions on those? Okay, if not, let's go jump over to Quick Study 1311, okay? The first part of it is right here, and the second part of it is continued on to the next page, right down here below, okay? All right, let me go ahead and take a look at that. Quick Study 1311. A review of the notes payable files discovers that 3 years ago, the company reported the entire amount of a payment, principal and interest, on an installment note payable as interest expense. This mistake had a material effect on the amount of income in that year. How should the correction be reported in the financial statements? Okay? Well, it says that it's material, right? You can come off that. It says that it's material. So, what do you do when you discover an error that actually occurred, in this case, 3 years ago? We handle it on the statement of retained earnings, don't we? Now, it's key. It is not handled on the income statement, okay? It's not handled on the income statement because that would muddy up the results of this period's operations, and it wasn't something that occurred this period, was it? Okay, so we handle it on the statement of retained earnings, or sometimes we call it the statement of stockholders' equity. And it's handled as a prior period adjustment on the beginning balance of retained earnings. Okay? We handle that as an adjustment to the prior, the prior year's, I'm not saying this very well. We handle this as an adjustment to the beginning balance of retained earnings. Okay? Make sense? Now also, you know how a lot of times in your financial statements you'll show this year's and prior years? Wherever that data is for the prior years is presented, that needs to be changed as well. Okay? But it's not handled on the income statement. We adjust the beginning balance of retained earnings. Okay? Okay, let's read the next one. Try to get it out of that glare. After using an expected useful life of 7 years, and no salvage value to depreciation its office equipment over the preceding 3 years, the company decided early this year that the equipment will last only 2 more years. How should the effects of this decision be reported in the current year financial statements. Okay, what do we do there? Anybody want to take a?
Change the percentage amount of the depreciation.
Yes, but do we go back to prior years and make a change? No. This is not a material situation. We would not be changing the beginning balance of retained earnings. This is, you remember from Accounting 1, Chapter 10, change in accounting estimate? Do you remember that? Like if you change the estimated salvage value, or change in this case the remaining years of life on a fixed asset, okay? We don't go back and change anything. As you said, we just change how much from here on forward that we're going to depreciate. Cool? All right? Cool. All right, and then I believe we did exercise 1311. Is that correct? Exercise 1311. All right? So let's take a look at that. Okay, this is exercise 1311. The following information is available for Amos Company for the year ended December 31, 2013. The balance of retained earnings at December 31, 2012, prior to discovery of error, is $1,375,000. Cash dividends declared and paid during 2013 were $43,000. It neglected to record 2011 depreciation of expense of $55,500, which is net of $4,500 in income taxes. Okay, so that is the error that we discovered. Is back in 2011, we neglected to record that amount of depreciation expense. The company earned $126,000 in 2013 net income. Okay, first of all, we have to ask ourselves, stay on this if you would, we have to ask ourselves if this is material. Okay, well, evidently it is, okay, because they're asking us to prepare a statement of retained earnings, okay, for 2013. But if you look at the size of that error compared to, for example, the current year net income, that's probably material, okay? Now, a $55,500 error for like Sprint Corporation, which has billions and billions of dollars, that would not be material. But for a company this size, a $55,500 error would be material, okay? So you have to make that decision. Sometimes that decision is not as clear-cut as you might think, and you might need to consult a CPA or an attorney or something like that, okay? All right, so let's take a look at that answer. All right. Let's take a look at this. Okay. Exercise 1311. Okay, we're going to do a statement of retained earnings for Amos Company for the year ended December 31, 2013. Okay, the first thing we're going to do is we're going to report that retained earnings balance that was previously reported. Okay, and they tell us that's $1.375 million. Then what we're going to do is we are going to make that prior period adjustment, okay? Now, this is the expense that wasn't recorded in 2011. Now, this is net of the $4,500 in income taxes. And again, this class does not really go into income tax too much. You'll get that in the tax class. So I'm not so concerned that you understand the whole income tax effects of this. But what I do want you to understand is this. If we did not record expense in that prior period, then that prior period net income was overstated. Agreed? And if that net income in the prior period was overstated, when we closed it to retained earnings, thus retained earnings is overstated, was overstated, right? So we have to subtract that. And in the way we're saying the retained earnings, this is what it really should have been. This is what we mistakenly, overcalculated it to be, but it really should have been this. You with me? Once we do that, then the rest of this is pretty easy. Then we add the net income, we subtract out the dividends, and we get our retained earnings for December 31st of 2013. You with me? Now, how does the market react when we have to make a change in a prior period? When we have to, the market doesn't like it. The market doesn't like it. As I said, when you tell somebody, hey, remember that annual report we gave you last year? Well, it was wrong, but here's this year's, okay? You might have reasons to be a little bit skeptical, correct? All right? Okay, we are now officially done with chapter 13, all right? Now, take a look. I'll tell you folks after the cameras stop rolling as far as when your chapter 13 Connect assignment is due. You folks at home, look on the red calendar on D2L, okay? But you are officially ready to do your chapter 13 Connect assignment. Cool? Now we're going to go not to chapter 14, but to chapter 15, okay? Chapter 15. And what this chapter is over is investments, okay? This chapter is over investments. Now, this lecture will have a little less of me yakking and more of you doing. So we're going to talk about some things, and then we're going to work on some things in class, okay? But let's talk about investments. First of all, let's know real clearly what we're talking about here, okay? This is a partial balance sheet, and you can see in red the things that are highlighted that we are going to be discussing in this chapter. We're going to be discussing short-term investments, which is in the current asset section. We're going to be discussing long-term investments, which is in the long-term investments section. We're going to be talking about long-term investments in common stock, and we're going to be talking about long-term investments in, like, for example, long-term bonds or debt securities. This lecture in particular, we're really going to focus on debt securities. And then the next lecture, we'll talk about equity, okay? So, we are in the asset section right now. We are talking about the asset section of investments, okay? Now, why would a company have investments on their balance sheet? Well, the same reason largely that individuals would have investments. They want to transfer excess cash into investments to produce higher income, right? For example, as you guys start saving for your retirement, do you think your broker is going to advise you to put all your money into a savings account that earns 0.3% per year? No. They're going to say to take a large portion of that and put it into investment vehicles that will hopefully earn a higher income, correct? So, it's not prudent for companies to have a lot of excess cash just sitting around. Let's get it into something that's going to earn some money, okay? So that's one motivation for investments. Another motivation, some companies are set up to produce income from investments. For example, you guys have heard about in Kansas City, there is a company called American Century, right? That's a mutual fund company. Well, that's what they do. They manage investments, okay? So for some companies, that's part of what their operations are. And then the third reason, and we'll just kind of touch on this, is some companies make investments for strategic reasons. Some companies make investments for strategic reasons. You can come off that. For example, there might be times that companies might invest in a customer or a vendor, okay? One real quick kind of elementary example is, as an example of this, might be, let's say you're a transportation company, okay? You do transportation, and let's say the rates that you charge your customers are somewhat fixed in contracts. Well, if fuel prices go up, that's going to be a big expense for you for providing your services, right? So your net income is going to decrease, correct? If fuel prices go up. So one thing you might do is maybe you would invest some of your money in some sort of company that benefits, that their income actually increases if fuel prices are going up, maybe Exxon or something. So that if and when fuel prices go up, that investment increased investment income that you earn from that investment will somewhat offset the increase in operation expenses that you are now incurring. You with me? That's a very simplified example. When I was in my MBA at KU, this was a very complicated subject that we went into as far as trying to offset risk by doing investments. But that's just kind of a simplified example. Kind of understand that? So that's the third motivation that a company might have for investments. Now, accounting for investments depends on three factors. First of all, is it a long-term or is it a short-term investment? Is it a long-term or is it short-term? Or sometimes we say, is it non-current or current? Is it a debt or is it an equity investment? That's a very important one. We're going to talk about debt today. Next time we'll talk about equity. And third, if it is equity, in other words, we are owners or shareholders, what percentage of the company do we own? Okay? Now, for the majority of this lecture and the lectures that come after, we are really assuming that we own less than 20% of the company for which we have equity investments. Okay? And that's usually the case. All right, let's talk about the short-term versus long-term. Short-term investments are readily convertible to cash, and they're intended to be converted to cash within the next year. And they are reported in the current section of the balance sheet. Okay? So short-term investments are going to be converted to cash within the next year. However, we have an exception. We do not include into short-term investments what we call cash equivalents. What are cash equivalents? Cash equivalents are investments that are both readily converted to known amounts of cash and they mature within the next 3 months. Okay? This would be like a 90-day certificate of deposit. Okay? A 90-day certificate of deposit. So, if it's going to mature in 0 to 3 months and it's a cash equivalent, it's actually recorded in the line of the balance sheet that says cash and cash equivalents. But if it's going to mature in between 3 months and 12 months, then it's reported in that separate line of short-term investments. Does that make sense? Okay? Long-term investments, on the other hand, are not readily convertible to cash, and they are not intended to be converted to cash within the next year. Predictably, they're reported in the non-current section of the balance sheet. Okay? All right, not too tough there. Yeah, Luke.
So when you intend to cash a long-term investment the next year, does it become a short-term, or do you still do you still account for it as a long-term? That's
a great question. Did you hear that question? What if you have a long-term investment that you're intending to, you know you're going to cash it in the next year? Yeah, then it would actually be moved.
Okay.
Okay. And you could have a long-term investment such as a debt security that's been out there a long time, but once it's getting ready to mature, you move it into the current section.
Okay.
So, good question. There's kind of a constant analysis that has to be done on one's investments to know how to properly classify them. So, but that's kind of the same with other assets too, right? With notes receivable, long-term notes receivable eventually become current notes receivable, don't they? Okay, good question. Okay, now let's make a differentiation between debt securities and equity securities. Debt securities reflect a creditor relationship, such as if you have an investment in a treasury note or a bond of the government or bond of a company or a certificate of deposit, okay? Those are debt securities. Think about those. Are you an owner of that entity? No. Are you a shareholder of that entity? No. You are a creditor in your relationship with them. You're going to receive interest revenue, correct? So that's a debt security. Equity securities, which we'll talk about next lecture, those do reflect an owner relationship. Like when you buy stock in a company, you are an owner, aren't you? Okay? And there you have investments in shares of stock, and you will probably receive dividend revenue, okay? But let's focus today on debt securities, okay, where it is a creditor relationship and we are not an owner, okay? Cool. Let's talk about the accounting basics for debt securities, okay? Debt securities are recorded at cost when purchased, and we receive interest revenue for investments in debt securities as it's earned, okay? Where interest revenue, as we earn it, we record that, okay? Now, come off that for a second. Let's make sure we understand. When we go back to chapter 14, we're going to talk a lot more about bonds, okay? But basically what a bond is if I buy a bond for like $10,000, I give the company $10,000 today, and in a way I'm acting as a creditor. And during the life of that bond, let's say it's 3 years, every 6 months they pay me some interest. So I have some interest revenue. And then at the end of the life of that bond, then they pay me back my principal as well. Does that make sense? That's how a bond works in a very simplified explanation. So, looking back at the slide, debt securities are recorded at cost when purchased. Interest revenue for investments in debt securities is recorded when we earn it. So let's look at an example. Most of this stuff an example will clarify. On January 1 of 2015, Matrix Inc., that's us, we paid Garmin Inc. $975,000 as an investment in Garmin's bonds. These are 2-year bonds, and they have a stated rate of 6% annually. Interest is paid semi-annually. What does semi-annually mean? Twice a year, every 6 months. And in this case, it says they are paid semi-annually on June 30th and December 31st, okay? Let's take a look at the journal entries. Well, when we purchase the bonds, we debit long-term investments, okay? And then we sometimes put in parentheses Garmin, so we can kind of keep track of these things, a little more easy. So we debit that for $975,000, we credit cash for $975,000, okay? Now, we record interest revenue as it's earned. Well, on June 30, we have earned 6 months worth of interest, correct? Now, how do we calculate the amount of interest that we have earned on June 30th? Well, we're going to take the principal amount, I'm going to try to write with a mouse here, times the interest rate, but then we take it times 1/2 because it pays every 6 months, okay? So what was the principal amount? $975,000, and we take that times 6%, and then we take that times 1/2. Henry, bang that out on your calculator over there, and make sure that 975,000 times 6% times 1/2, that should equal the amount of interest revenue that we show recorded above. Does it? Yep. Okay. So that's how we get that $29,250. And we debit cash, we credit interest revenue for $29,250. Okay? Now, that's the journal entry we make 6 months into this bond. How long a bond was this? Let's go back. This was a 2-year bond. So we are going to make this entry again December 31st, this exact entry, correct? As a matter of fact, how many total times will we make this journal entry that you're looking at right now? 4 times, because it's a 2-year bond, we make it every 6 months. There's 4 6-month periods in 2 years, correct? So we'll make that journal entry 3 more times after this June 30th. Then we'll also make 1 more journal entry on that, oh, they didn't show it, but on that final, let me go ahead and write it down. On that final December 31st, 2 years after we purchased the bond, thank you, 12/31, we are going to debit cash and credit long-term investments, Garmin, for the principal amount. because they're going to pay us back our principal. Okay?
So that's made on the 31st.
Well,
But in
let's
the
go-
notes it says on January 1st that same exact thing is made.
Like on the next slide.
On the next slide it says the exact same entry, but it says January 1st.
Oh, yeah, it does. Okay. Yeah, you're right. Well, this is 12/31 of
16.
16. Yes. Okay. All right.
So would you also make that other journal entry for the cash and interest revenue on the same 12/31?
Yeah, you would.
Okay.
Now, what they did here is sometimes you make this on 12/31/16. Sometimes you make it the next day on January 1 of 17.
Okay.
Okay. But here is that journal entry. You can see it better and more clearly written right here. Okay. On January 1 of 17, they do. I didn't think they showed the journal entry for the bond maturing, but they did. Okay. So either on January 1, 2017 or December 31 of 2016. Okay?
So
Good.
that's them giving you your money back.
That's them paying you back the principal. During the life of the bond, they paid you interest.
Yep.
And then they don't pay you off principal gradually. They just pay you interest during the life of the bond. And then at the end, when the bond matures, that's when they pay you back all your principal. Cool?
So how is that bond making profit at all for Garmin since they're paying out expenses?
For Garmin? Well, here's the reason, is at the inception of the bond, they received $975,000, didn't they? Okay? Which they needed the money to do something with, right? So yeah, they have to pay that back at the end, but they've had to pay interest during the life of that bond. Just like if you want to buy a house, you've got to have some money. So you take a loan and you pay that back, but you also pay interest for the cost of having that money.
Okay, makes
Okay?
sense.
Make sense? So, good question. Now, these journal entries that we looked at for long-term investments, for short-term investments, everything would be the same except we use the account called short-term investments. Make sense? Okay. All right, let's look at one more example here. Different security. On August 1, 2015, Matrix Inc., that's us, we paid Sprint Inc. $100,000 for their bonds. Okay? The 10-year Sprint Inc. bonds have a stated value of 7% annually. Now listen to this. Interest is paid semi-annually on January the 31st and July the 31st. Okay? Well, when we acquire those bonds, we debit long-term investments for Sprint and credit cash for $100,000, right? Now, on December 31st, we have to make an adjusting journal entry, okay? Now, here's the way I think through this adjusting journal entry. Let's go back a slide to the inception of this bond, okay? Henry, have your calculator ready, okay? I want to figure out how much interest we are normally going to receive when we get paid for a 6-month period, okay? So I'm going to take the principal amount of $100,000 times the annual interest rate of 7% times what? You guys tell me? Times 1/2 since it's paid semi-annually, okay? So 100,000 times 7% times 1/2 equals what, Henry?
$3,500.
$3,500. So every 6 months, we are going to receive cash of $3,500 interest revenue. You with me? Okay, now let's go to the next slide. Because what happens is we have a fiscal year end of December 31st, don't we? Now, do we get paid interest on December 31st? We do not. But we've earned some interest, haven't we?
Okay.
So we have to make an AJE. Remember adjusting journal entries, AJEs? We have earned 5/6 of the amount of that $3,500 for the month of August, September, October, November, December, right? Now we're not getting paid our cash here, but we need to show the 5/6 earned. So, Henry, if you take 5/6 times 3,500, bang that out real quick.
2,916 or
Okay,
17.
but if you round it, it's 2917, correct? That's how we get that amount. So what we'll do is, I say it, that approximately equals 2917. So we make that journal entry. We debit interest receivable and we credit interest revenue, correct? So we can book the revenue which is earned in the proper period in which it was earned, right? Chapter 3, Accounting 1. Questions? Any questions on that, folks? You can come off that.
Do you round it every time? Do those?
Yeah, just round it to the dollar. Okay, for your purposes now. Okay, what I want to do now in class is I want to do a handout, which I will give you here in a second. And it is the Leonard handout, okay? The Leonard handout. Where did I put those? Okay. I want to do the Leonard handout. Let me show you an example of what it looks like. The Leonard Company handout. Do that whole thing. And then after you're done with that, I want you to do Quick Study 15.7. Quick Study 15.7. Okay? And I'll lay that up after the music starts. After a minute or so, I'll lay up Quick Study 15.7 in case you didn't bring it. But what I want you to do, they're going to play the music, do the whole Leonard Company handout, and then do Quick Study 15.7, and then we'll go over the answers. All right? right. Okay, we are back. Let's go ahead and go over these real quick, okay? Let's do Leonard Company first. On January 1, 2014, Leonard Company paid $8,000 cash to purchase a 3-year bond at par value of Sprint as a long-term investment. The bonds pay interest semi-annually on June 30 and December 31st. The annual interest rate for these bonds is 6%. Make journal entries for the following dates. Okay? Well, on January 1 of 14, we debit long-term investments, and we might put Sprint there in parentheses. And we credit cash for how much? $8,000. Okay? So that's our journal entry there. Right? Okay. On June 30 of 14, we earn and have received some interest, don't we? How much do we earn? Let's calculate that up here. We take 8,000 times 6%, correct? Times 1/2, since it's semi-annually, and that equals what? Is that 240 bucks?
Yeah.
Okay. So we debit cash and credit interest revenue for $240. Is that correct? Okay, questions? Now, we make this same journal entry right here, right here, right here, right here, and we also make it down here, don't we? Okay? So we make this journal entry a total of how many times?
6.
Oh, 6. 1, 2, 3, 4, 5, 6. Correct? But also on 12/31/16, we make an additional journal entry, don't we? And that's when we receive our principal. How much principal, how much cash do we get paid?
8,000.
And what do we credit for 8,000?
Long-term investment.
Long-term investments, Sprint. Correct? Okay, so this exact same journal entry 5 additional times. Okay, you with me? Okay, now let's do quick study 5-7. Thank you. Quick study 15-7. We're not going to go back to chapter 5. We're going to stay in chapter 15. Quick study 15-7. On February 1, 2013, Garzon purchased 6% bonds issued by PBS Utilities at a cost of $40,000, which is their par value. The bonds pay interest semi-annually on July 31st and January 31st. For 2013, prepare entries to record Garzon's July 31 receipt of interest and December 31 year-end interest accrual. Okay, well, let's do that. Okay, well, they don't ask us to make a journal entry for the purchase of the bond, do they? Okay, just for those interest dates. So, the journal entry on July 31st would be this right here. We debit cash, credit interest revenue for $1,200. How do we calculate that? We take the principal or the par value of 40,000 times 6% times 1/2, right? And we actually receive cash on July 31st, correct? Now, we have to record an AJE at December 31st, don't we? Okay. Now, how much of that $1,200 have we earned? 5/6 again, for August, September, October, November, December, right? 5. So we take 5/6 times 1,200, and we debit not cash, but interest receivable for 1,000 and credit interest revenue. And if you don't know whether you debit cash or debit interest receivable, just ask yourself, is this a date that we receive cash payment? And it's not, is it? We don't receive any cash on December 31st. It very clearly says that they pay interest on July 31st and January 31st, not December 31st, right? So those are the entries, okay? Any questions on Leonard Company or Quick Study 15-7? Okay, what I want you to do for homework then is exercise 15.2, 15.3, and 15.4. Now remember, you can also do your chapter 13 Connect assignment. And remember, this was lecture 208. After lecture 210, we have our test over 12, 13, and 15. But do exercise 15.2, 15.3, and 15.4 for next time. Thanks, guys. See you later.